There's a man living in Palm Beach right now who spent $3 million on lifestyle expenses last year. Dinners, flights, and cars. And he reported an income of exactly zero to the IRS. And the most frustrating part is, he didn't break a single law. In fact, the IRS likely sent him a refund check. In some ways, the tax system is in fact broken. But if you look at it differently, you can make it work in your favor. The tax code is not a list of penalties for making money. It's a treasure map of incentives for moving that money. The wealthy don't focus on deductions. Deductions are for people who earn paychecks. The ultra-wealthy focus on something entirely different, called realization events. See, in the eyes of the taxman, you haven't actually made money until you sell the asset. If your stock portfolio goes up by $1 million this year, you owe nothing. The moment you click sell, the government takes 20%. Therefore, the golden rule of the wealthy is simple. Never sell anything. But this creates a paradox. If you have $10 million in stocks but never sell them, you're technically rich, but you have no cash to buy groceries. You're asset rich, but cash poor. So, how does the billionaire pay for the yacht without selling the stock that pays for it? They use a strategy called arbitrage financing. Welcome to Retire Rich. And today, we're exposing how wealthy retirees avoid taxes legally. So be sure to like and subscribe, and let's get into it. Here's exactly how it works. Instead of selling $1 million of stock and triggering a $238,000 tax bill, the wealthy individual walks into the bank and asks for a securities-backed line of credit. They pledge their portfolio as collateral. The bank looks at the $10 million, feels very safe, and hands over a check for $1 million cash. Here's the catch, and it's a beautiful catch. Debt is not income. You do not pay taxes on a loan. That $1 million hits your bank account completely tax-free. You can spend it on a house, a business, or a trip to the Maldives. The IRS sees nothing. Now, you're probably thinking, wait, what about the interest rate? You're trading tax for interest. This is where the math gets interesting. When you have significant assets, banks don't charge you credit card rates. They charge you the SOFR rate plus a tiny spread. Often, the cost of the loan is lower than the average annual growth of the portfolio. So, while your $1 million loan costs you maybe 5% in interest, your $10 million portfolio stays in the market, compounding. You're literally making a profit on the money you borrowed to live. But it goes deeper. What happens when the bill is due? You don't pay it off with income. You simply refinance the loan or let the portfolio growth cover the interest. You kick the can down the road, year after year, decade after decade, letting your assets grow tax-free while living on tax-free debt. However, there's a fatal flaw in this plan. Eventually, you die. And usually when you die, the estate tax comes in and shatters everything, unless you use the step-up loophole. This is the mechanism that creates dynasties. When you pass away, the cost basis of your assets, the price you originally bought them for, is reset to the current market value. If you bought Amazon stock at $10 and it's worth $3,000 when you die, your heirs don't inherit the $10 cost basis. They inherit it at $3,000. They can sell that stock the day after your funeral to pay off your bank loans, and they pay zero capital gains tax. The debt is settled, the taxes are erased, and the remaining wealth is transferred clean. But let's say you aren't close to passing away, and you actually do need to sell an asset. Maybe it's a business you founded, and you're looking at a massive tax bill. You don't just sell it, you transfer it into a charitable remainder trust, or CRT. You move the asset into the trust. The trust sells the asset. Because the trust is a charity, it pays zero taxes on the sale. The full proceeds are then reinvested. The trust then pays you a salary for the rest of your life. You get an income stream based on the full pre-tax value of your business, not the after-tax scraps. You literally monetize your own generosity. The system is designed to punish income and reward ownership. As long as you're working for money, you're losing. The moment your money starts working for you, the tax code switches from your enemy to your partner. Of course, executing a CRT or a securities-backed line of credit requires a specific type of portfolio structure. Because if you pick the wrong assets, the bank will liquidate you during a market dip. You need to understand the volatility index of your own holdings before you ever sign that loan paper, which is exactly why you need to watch our upcoming video on asset allocation for maximum stability. So be sure to subscribe, and I'll see you there.